Thanks for joining our webinar today. I'm going to go ahead and get started. I know some people are just joining and getting their mics set up and their audio set up. So let's just start with outlining the presentation and a little bit about the agenda today. We're going to speak on how to use private equity in your portfolio. And, I'm Jimmy Clark with StartEngine. Here at StartEngine, we give access to everyday investors to the next wave of opportunities. So let me show you what the agenda is going to be today. We've got three topics that we're going to discuss. First, why StartEngine Private? Second, we're going to speak about why private investing has become mainstream. And then thirdly, we're going to speak on how you can access pre-IPO companies now. And then we should have some time at the end, about 10 minutes for questions. If you have questions throughout the presentation, I'm happy to answer them at the end. I would recommend emailing them to me. My email is up here on the screen, and I will show it again at the end as well. Jimmy.clark@startengine.com. If you put question in the subject line, I've got my inbox filtering for the word question or questions. So as you have questions in the presentation, feel free to send them to my inbox, and I will cover them in the order that they come in when the question section comes up. So let's begin with why StartEngine Private. StartEngine started in 2011 as an incubator to help StartEngine. StartEngine was the engine for startups. We're an incubator to help these tech startups. Howard Marks is our CEO and founder. He's a Silicon Valley success story himself. He started off programming the Apple II for computer mouses, one of the first people to bring a computer mouse to market for everyday people. And he continued to grow businesses throughout his career, including Activision, the video game company Activision Studios, of which he was the co-founder and chairman of the board until their merger with Blizzard. And he was also the founder and CEO of Acclaim Games. And while working through numerous tech startups, he wanted to help everyday tech entrepreneurs start their businesses. And StartEngine was founded as an incubator. Over time, we worked with a number of tech companies to help them become successful startups. We had a number of startups that, as we were working with them, we realized there wasn't a great product market fit for them. And over time, crowdfunding became more and more popular. You may recall the original crowdfunding companies such as Peloton, who raised money on GoFundMe. Their investors never saw a dime in profits, but they became one of the biggest exercise companies and ended up having a very successful IPO. When the laws changed in 2016, they allowed investors in these crowdfunding companies to actually have an equity share. And StartEngine was at the forefront of this, pivoting from just an incubator to help tech startups to also provide funding to these tech startups in addition to being an incubator. And this really saw an impact towards our business. And we quickly raised by 2021 over $500 million through StartEngine. And by October of 2022, we actually had over 1 million users on our platform. And by late 2022, StartEngine itself became one of the largest crowdfunding companies out there. And we ended up acquiring one of our major competitors, Seed Invest. So today, we have over $1.5 billion invested by over 2.1 million investors. It's a very large company, StartEngine. And what's nice about 2.1 million investors have invested $1.5 billion is that's relatively a small scale of investment per person. And we like that we can give access to individual investments to everyday Americans or everyday investors. We actually have investors all over the world as well. However, one of the biggest pivot pieces for StartEngine was in 2023, we launched StartEngine Private. And this was an evolution of StartEngine itself, where we had early stage companies that people wanted to invest in, but people wanted to make larger allocations to pre-IPO or large companies. And that's why we launched StartEngine Private. So StartEngine Private is access to pre-IPO companies. And today, what a pre-IPO company, it's typically a large tech company that has a unique product, but they've also established themselves as the market leader in their respective industry. And we believe that in the next 1 to 4 years, they could be having a public listing or a acquisition event because they're so large and successful within their own individual space. And I've got the logos on the screen of a few different companies that fit this profile, like Grok and Cerebras. They're AI chip companies competing with NVIDIA. There's Anthropic, which is a competitor to Google and OpenAI, along with Perplexity, which we mentioned here. There's also a competitor to theirs. Kraken, which is a crypto exchange. Stripe, it's a transaction system that probably everybody on the call today has used at some point or another, whether they know it or not. And what's nice about this is you get access to these companies. They're backed by the top venture capitalists out there, but you have manageable minimums rather than a $500,000 or $500,000 or $1 million minimum. Our minimums are typically around $15,000, and we have some that go down as low as $5,000 minimums to be able to access some of these private companies that are in the pre-IPO stage. So now that you know that we have access to these, why private? Why would you invest in a pre-IPO company? And I think it goes down to the market has changed over the last 20 years with how major companies, family offices, and institutions are investing their capital. And for everyday investors like us, we typically go after the public markets. So why has private become mainstream? I mean, look at the S&P 500 today. 38% of the S&P 500 index is invested in just 8 companies. Now, I know these are all household names, and they're companies that many of us on the call feel very strongly about. But the fact that 8 companies make up 38% of the S&P 500 index, an index that typically makes up a large chunk of an investor's portfolio, you have to ask, why is this happening? And the main reason is within the tech world, they call this disruption. All of these companies are terrified of being disrupted. This has happened before. We just talked about a couple of companies like Anthropic and Perplexity, and there's companies like OpenAI. These companies themselves, they're challenging a decades-old notion that Google search is the best and only option that we have for asking questions or getting answers. And with this new AI revolution that we're seeing specifically to Google's search business, there's a legitimate question if Google is going to be the leader in just 5 years' time from now, which that's been a very long time since that's been a question for anyone. And all of these companies have different aspects of their business that are exactly like that. They are very concerned about being disrupted. So what they're doing is they're heavily investing in their own business. They're investing in other companies themselves so that if they are successful, then they have a piece of it. Microsoft, for example, is a major investor in OpenAI. And I know I used the term disruption a few times, and this is something that is not necessarily unique to the tech industry, but it is at the forefront of every tech investment. And I wanted to make sure that you understood why. It all comes down to the original big tech firm, IBM. IBM was an American business success story. They made the biggest bet in corporate history in the early 1960s. They had a top secret project based on feedback from their clients to launch the System 360, which essentially allowed for, at a high level, computers and machines to communicate with each other. So if you had one machine doing something, you could just send that data off to another machine. And this was revolutionary at the time, and it took decades for any competitors to be able to catch up to them. But boy, when they did catch up, IBM was disrupted. They were the largest company in the United States for the better part of 30 years. And while they continued to focus on business machines, we saw other industries like personal computers pop up, and they just never got into it. So while they're still a major player and major company today, they were dramatically disrupted in the early 1990s. And the sheer fact that this could happen to a company has changed the tech industry itself. And that's why we saw in the late 1990s so many companies going public and being able to access these companies very early. There were some companies that you could access that were coming out with a $75 million valuation that are actually in those top 8 companies today. And historically, when investing, small cap companies have always outperformed large cap companies. And to define that, for those of you that aren't very familiar with this terminology, within the investable universe, the top 500 companies by market cap are large cap or the S&P 500 companies. The next 500 largest companies are considered mid-cap companies. And then the following 2,000, so that would be the 1,001th to the 3,000th largest companies that are publicly traded in the US are considered small cap companies. And what's traditionally happened is these companies list as a small company and they continue to be the best outperformers as they make their way to being a large cap company. And we saw this 15, 20 years ago as relatively normal. And something changed over the last 15 or 20 years where these companies, they don't go public like they used to. They don't need to because there's so many institutions, there's family offices that want to invest in these companies because traditionally when you invest in a portfolio of them, they significantly outperform the overall market. So we've seen that these companies, rather than going public, they're just raising funds in additional private rounds. And we've seen some records as far as number of private rounds from a number of companies because they don't need to go public. And that's hurt everyday investors that are trying to access their investment portfolio through just public markets. And that's why you might have seen in my email that I sent out about KKR. They surveyed family offices, and their survey included only people that had $30 million in assets or more, and they used a professional, specialized team to manage their money. They actually allocated 56% of their portfolio to alternatives and 28% of their overall portfolios to pre-IPO companies, meaning that if you're diversifying amongst 20 different companies, that means they're putting $500,000 in 20 different companies on a $30 million portfolio on average. Now that is major family offices, but it's important to know how family offices are investing because it's always good to keep track of that. But as an individual person that maybe doesn't have 30 million in assets, I think there's few of us that do, but someone that might be an accredited investor that has assets but wants to limit it, I like to think of Larry Fink. He is the CEO of BlackRock, and he has been touting for years now the 50-30-20 portfolio. And this is a slight adaptation to the typical 60-40 portfolio that was popular for many years, where he has 50% in equities, 30% in fixed income, and then 20% in alternative assets. And of that, he broke it down into 10% into pre-IPO companies and 10% into other alternatives. And I think this is an appropriate allocation for a accredited investor that is someone that has between $1 million and $30 million net worth, and allocating this portion of their portfolio for funds they don't necessarily need in the next 5 years. But it is important to take into consideration market changes and changes with the amount of institutional capital going after these companies, because as you're looking for areas of growth in your portfolio, if you've seen your small cap companies underperforming large cap companies, adding pre-IPO companies, and not just adding one, but adding a number, may be able to provide that additional diversification and growth that you're looking for in your portfolio. So now that we've established why this makes sense, how do you actually access them? Well, as you might have guessed, you can access the pre-IPO companies through StartEngine. On the left side of the screen, you've got a picture of one of our past funds. It's the AI Nexus Fund. And what we do is we do individual offerings as well as overall funds so that you can allocate to these companies. In the AI Nexus Fund, it was a great diversification play. They had Perplexity, which is a great open AI competitor. They had Cerebras and SambaNova, which is AI chip companies. They had Agility Robotics, which is one of the most advanced robotics companies being tested by Amazon. They had Gecko Robotics, which they actually monitor large, expensive equipment, think $1 million plus equipment, having year-round constant monitoring robots attached to them so that they can make sure that if there's something that breaks, they're able to fix it right away. And more importantly, they can extend the overall life of those by monitoring it on a constant basis for wear and tear. And then there's also within the space, Stoke was a space player, but this is just an example of the type of diversification that you can access through a fund, but you can also pick and choose your own individual names yourself as well through StartEngine. We've completed over 75 of these pre-IPO offerings. Majority of them have been selling out relatively quickly. We've seen over $100 million raised since we launched this platform. And the average investment, while we see some with $5,000 to $15,000 minimums, is actually $25,000. And we've added diversified funds like the one shown here. And also you can access this through IRAs, and we have some that are specific to qualified purchasers. So I mentioned that these investments are for accredited investors. And what that means is it's an investor that meets one of three requirements. From a net worth perspective, they have to document $1 million in net worth, not including the primary residence. From an income perspective, this is a second way that you could qualify as accredited. If you had income over the last 2 years on your taxes of either $200,000 or $300,000, depending on if you're married or not, then you would qualify as accredited. And then finally, if you are a registered financial advisor, you are considered to be accredited as well. So if you meet one of those three requirements, you're an accredited investor and able to invest in these companies with minimums between typically $5,000 and $20,000. We also have some funds that are specific to qualified purchasers. And what that means is not only do you meet the accreditation rules, but you also have $5 million in assets. Now, these are where we have some of the larger names where we want to have additional investors coming into them. And then finally, you can see on here that you can access it through IRAs as well. This is something relatively new. So if you have been with StartEngine for a while, you may not necessarily know that over the last few months, we've allowed for IRA investments. So you can actually open an IRA account right through StartEngine. We've seen significant assets coming in since we launched them in August, where you can just go straight onto the StartEngine platform, create a new account. And when you create an IRA through StartEngine, you're actually creating an IRA with Equity Trust Company. They are the largest self-directed IRA custodian, and they would be the company that actually has custody of your funds when you invest through an IRA. There's also tax advantage diversification with IRA investments. If you're familiar with Peter Thiel, one of the co-founders of PayPal, he famously invested in this company with his Roth IRA and actually became a billionaire within his Roth IRA, which it's brought up a lot of conversation, but at the end of the day, he made a very intelligent decision to make a big bet with his Roth IRA. He was successful with that bet, and he made about $2 billion in a Roth IRA where he doesn't need to pay capital gains taxes on it because he paid it in advance. So there are some tax benefits potentially to investing in companies that you have a strong belief in their growth in an IRA. So we've also got $18 trillion in the United States tied up in IRAs. As you are making investment decisions too, I mentioned pre-IPO companies have a 1 to 4 year typical horizon. Now, sometimes it happens sooner, sometimes it takes a little bit longer. But if you are thinking of it as, if you make 10 investments and 8 of them are probably going to go public or have a listing event in the next 4 years, when you're making decisions about long-term holdings that you may not be able to sell in any given day, IRA makes a lot of sense for a bucket of investments that you're planning on holding for 5 years or longer. You can add to pre-IPO companies. And again, we've seen dramatic allocation since then where people are targeting between 5 and 15 different investments on the StartEngine platform to be able to get access to the pre-IPO companies. And some of those companies that you probably have heard of in the news recently. Here's some just recent news articles on private offerings that we have at one point or another had on StartEngine. And I want you to think of this in the context of the S&P 500. The smallest companies on the S&P 500 have a $22 billion market cap. And we're talking about companies like Anthropic, who had $70 billion in revenue projected by 2028. Cerebras had an $8.1 billion valuation. They're an AI chip company. Databricks has a $100 million recent partnership with OpenAI. One of the largest private companies today is Databricks. Lambda Labs is a multi-billion-dollar deal with Microsoft. They've also been in the news significantly lately. Perplexity just raised $200 million at a $20 billion valuation. Ripple also raised funds at a $40 billion valuation. Then finally, Stripe had a $106 billion valuation, surpassed the previous peak. So you can see these are major companies that have significant business interests, and they're not just a startup company. They're already proven themselves to not only be a unique type of business, but they've set themselves up as industry leaders within their own space. And that's what you can access through StartEngine. And on our StartEngine site, you might see this section up at the top, pre-IPO deals. You can also access it through StartEngine Private, but this is what the homepage typically looks like. As you look through, you can see companies like Nuro, an autonomous driving car software company that is leading that industry. So that was the prepared materials I had for the presentation. Again, if you have any questions, feel free to email them to me, and I will read them out now. Jimmy.clark@startengine.com. So yeah, I see one question coming in around the timeline. How long do you typically have to wait for an exit or a potential return on the investment? And it can vary between 1 and 4 years on average. Sometimes it happens much faster. I showed you the AI Nexus fund a few slides back that had Samba Nova in it. And that was an offering that about a month ago you could have invested in. And one of the holdings just announced Samba Nova that they're being acquired by Intel. So while on average it's 1 to 4 years, sometimes these happen faster. These are major companies, and a lot of the publicly traded companies like Intel are very focused on competing with NVIDIA right now. So by acquiring Samba Nova, they're making a play to be a stronger competitor to NVIDIA. So you'll see that sometimes it happens sooner. Every once in a while, they decide to continue raising funds, and it happens a little bit longer. But on average, when we have an offering on our platform, we believe that in the next 1 to 4 years, we're likely to see an exit event. And I see another question about where on the site you can access it. So on our platform, when you go to Start Investing under StartEngine Private, where you can see pre-IPO deals here, where you can access the site itself for pre-IPO deals. And that's where you're able to review the current offerings. Now, they change on a frequent basis. I've seen some offerings sell out in a couple of days. I've seen some that are available for several months. It just depends. And what's nice is when you click into the individual investment, you can actually see the minimum investment there. Like, for example, the Series Nero, which you can see on the screen. You actually click into it, you can see the details on the offering. You can see it's got a $7,500 minimum. Okay, that was all the questions that I saw come in. Again, if you have additional questions that come up or would like to, on a one-on-one basis, request any questions or discuss any of our offerings further, or StartEngine Private in general, feel free to either email me at j.clark@startengine.com or give me a call at 312-500-6438. And I can also receive text at that number, so feel free to text me as well. And thank you so much for your time discussing StartEngine Private. We discussed why private investing makes sense, why StartEngine is the place to be able to access them as an everyday investor, and then how you can access pre-IPO companies. Thank you so much for your time.